Good afternoon. This is Ken at Tortoise Capital with a review of the weekend report for February 2nd, 2019. Just a note, I've updated the tortoisecapital.net website homepage that now includes the upcoming scheduled workshops for this year for April, May, and November, and improve the pricing on the archived versions of previous live trading and research weekends. There's a very good deal on those now, and you should consider that. All right, market classification, we've moved up into sideways normal on an annual basis using NDX 260. We are at the higher end of neutral at 60 out of 100. The 10-day market position is overbought at 89 out of 100. In the market mosaic, we've just moved into the sideways channel here within 2% of the 200-day moving average. The slope of the 50 is yellow neutral. ADX is still a neutral 19.3, but the bull's getting stronger. Risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. It's at 1.2. That is firmly into risk on conditions. We take that score and look at the last 5,000 trading days and find the z-score, which is the standard deviation score of that reading compared to the last 5,000, and we have a z-score of 2.12. That means we're more than 2 standard deviations better than the long-term average. Here you can see a 90-day histogram of that indicator. We read this just like a regular MACD histogram with winter, spring, summer, fall, back into summer, winter, spring, summer, drifting into fall. The sweet spot for swing trading is when it goes from winter and just into spring, and then really unfolds as it gets into summer. When it rolls over into the fall, we're cautiously optimistic. We're aware of the possibility of profit taking and weakness creeping in, so it just causes us to take our shots carefully and to manage risk even more closely. For blended monthly rebalancing, you can see the holdings for 1 February going forward until March, and then the leaders in each of these portfolios based on Friday's close. Our theoretical exposure in ETF2, that should read 40%, not 30%. Quick look at some ETF portfolios. Real estate, emerging markets, Latin America continue to dominate. A very good week for Latin America to continue. In 32 ETF, Brazil now joins ILF near the top. So the alternate, the non-U.S. sectors like gold, emerging markets, China, all had pretty good weeks. Industrial started their comeback. The diamonds are cooking right along at 2%. In the Dow 30, leadership here, Procter & Gamble, Merck, and Nike. And then Boeing made a significant move. I'd be looking for more momentum out of Boeing. Pfizer also had a nice run. And since that's lagging its peer in Procter and Merck, I'm looking for some more momentum out of Pfizer. IBM's held on to its gains. Amazing run in GE. It was either going to go bankrupt or rebound, and it voted for the latter. Apple has been horrible, but it's showing signs of life here. In the sector spiders, semis, real estate, and but also this technology did pretty well. Biotech had a nice run. Metals and mining. So it's interesting how the recovery from horrible conditions quite often sets the stage for nice and interesting swing trades. Notice that 4 out of the 5 4% plus weeks all came out of the lower half of the table, so it's worth watching those. So now we should therefore be looking at regional banks, retail, farms to continue. ETF Max, some winners over here in gold and Brazil. Everything gold looks good. ETF regional report. Emerging markets, Latin America really dominating. I slowly incremented the improvement here. Next week, if we continue to have strength, we'll follow the move here. But this run has been so unprecedented that I'm reluctant to start adding major quantities here on the basis of asset allocation. So let's look and see what we got next week. Sector spiders, healthcare, industrial starting to lead the way. Still lots of room to recover in energy. World market model. This is the Dow up here in the upper left of the U.S. Russell small cap growth down here in the lower right. Otherwise, the U.S. is below average. So although it feels really good, there's been other places doing much, much better, the Asian countries especially, and of course, as we know, Brazil and Latin America. ETF top 30, different lens, but shows basically the same trend lines as we saw before with Brazil, India, emerging markets, gold and silver. Quick summary of our basic strategies for using this relative strength model that looks at 3 and 6 month performances to turn that into swing strategies for shorter term leverage. And then the liquidity table shows you the top 30 ETFs based on average daily dollar volume of the last 30 days, and then their relative volatility, so you can find short-term targets of interest. Shifting to the daily. Market health check. Cleaned this up a little bit. I thought maybe the RAF regression channels were getting a little cluttered, so here we have I've substituted with the 10-day trading range. We're near the top of that, and then the 30-day trading range to get that sense of where price is inside those index. You can actually think of those as the NDX. So you have a visual move near the top, and we've recovered back to the edge of the 200 and to the RL 270 long-term fair value. So that run is done, and now it remains to be seen what's going to happen with all of this congestion here at the 200-day. I think there's a real good chance to continue. The only thing that can slow it down, in my view, is the lack of any progress in our political situation. But the economic signs from the jobs report was looking very favorable, so I think there's still room in this thing to keep going. And really, it's got to get above this support level here, out of the Z3 line, basically, to keep going. In the MACD histogram, the turning point here from winter to spring, rolling into summer, and again, this little slowdown here is indicative of approaching a significant technical and emotional price level up here near the 200. I think people are going to look to buy, and that the fear is over. We'll see. It's not unusual then, coming out of a bear like that you would see some short possibilities here in the overreactions. Now, those are really good targets to have. I'm going to wait to see if there's weakness before I get into those on the short side, and I will start intraday first. But compared to the internationals, the U.S. signals, or the U.S. symbols, have been weaker, and so that's why they make good targets. But you can see the strength up here in Latin American emerging markets. 10-day max pains will be framing a couple of these for our weekend quizzes, which we're going to start that for you to check yourself against some school solutions. So we'll be looking at probably GE and McDonald's for sure. Inside the Dow tactical summary, DuPont, Verizon, Microsoft, Goldman, Caterpillar are the top 5 based on max pain range compression. We have some nice auto framer risk to reward ratios here. They were the big losers in red here on Friday. The winners were in green based on one-day percentages. I want you to notice where the strength has been. Boeing, no signals fired, but it's had a really nice bit of outperformance. Procter & Gamble, I also want to highlight its outperformance. Plus, it broke out of its 10-day trading range, and so did ExxonMobil decisively with a score of 178. So we're going to look at ExxonMobil and Procter & Gamble as continuation patterns based on their NDX readings. That'll be one of the quizzes. In the ETF, lots of dojis, plenty of things firing on the overreaction shorts. But again, the same logic. I'm going to wait to see actual evidence of failure before I would start looking to pile on those. And I'm going to concentrate more on the U.S. indexes. Oil and energy both had big days Friday. And because that sector was lagging, I'm looking for some more possible momentum in there as a continuation pattern. Daily pinch and stretch report. I like that Merck and Coke, Johnson & Johnson have all leading the way on the most compressed. They haven't reached super pinch status yet, but they're leading the way for lack of volatility, so it would not be unusual to see them posturing for a big run. You can see some numbers off those from the auto framer for things that we're going to frame later. The daily squeezes are things that had a compressed range on Friday, and if we get an orderly entry and then a breakout, and it tests the 10-day high, or goes up and makes a range step move, well, then these are the risk-rewards ratios that you can expect to see. So it's very interesting that this is dominated by indexes like the Spiders, the Russell, and the mid-cap. So a quiet day Friday, and so I'm expecting some continuation patterns on Monday. The seasons of MACD histogram for the Dow. Spring and summer are the ones that I'm really interested in right now on continuation patterns. You can see how the leaders have been Procter, Coke, Apple, Cisco, and IBM, all well above their zero line and their long-term river. Only Verizon has been kind of bucking the trend and is still decaying. That may be a longer-term value play once that makes the turn from winter and heads back into the spring. Pfizer and Merck have already made the turn, and because both of those are leaders in the clubhouse here this past week, there's a lot of room for them to still go, so we'll be framing Pfizer and Merck as well. Nice orderly move here in the S&P. What I want you to notice is the importance of this chart. I mean, the market condition using the slope stat. The negative slope was more than 2 sigma below the long-term average and the zero line, and then it crossed its own 10-period moving average here, and that corresponds to a shift and a rebound potential right here at 255, and that's giving you more than a 10% move just by following that key signal. Now, the fact that we are more than 2 sigma above the zero line just says how steep this move has been, and now the fact that we've got that amazing move and getting ready to run into some resistance here near the 200-period moving average says the next move is more likely to be one of these little legs if it gets through that 200, but a pullback here would not be unusual. So notice when you get more than one SD away from the long-term average and then it crosses back over it at an extreme condition, that's almost like a P1 but for the slope stat, and that's been a reliable indicator of a reversal of fortunes like this one. And now this one shows you right here. So pretty good ideas for you right there. And that's everything I want to cover once we get off. Let's get off this one. So the big sell-off, testing at the edge of the river, cross the river to the far side, testing, and then continue to resume. So that's why I think there's some room for this to get going. In this hump, it couldn't even get to the edge of the river. In this one, it hit the river and failed fast. This one has held for 2 or 3 days outside the river, and that's why I'm cautiously optimistic. But again, it's got to get through this cluster here of around 275 to 280, and then it's free and clear to 295. All right, that's everything from Tortoise Capital, keep your risk measured and your powder dry.